All right, so I'm going to do a follow-up video to the one I did on the Vanguard Managed Payout Fund, and the ticker is what is this ticker? VP, hold on just a second, VPGDX, VPGDX. So let's dive into this, man. I can't tell you how many questions I've got on this fund. I'm not a fan. I'll just be probably up front with you. Did you hear Pablo growl? He's not a fan either. So let's dive into this. So this fund actually has a longer track record than I had thought. For some reason, I thought it just came out 2014. That's not true. It's come out 2008, April 2008. He's growling like crazy over here. Give me a kiss. All right. So this is interesting. Allocation 50 to 70% equity. You'll see this yield is 6.44. Looks pretty good, doesn't it? Assets only 1.87 billion, which is kind of, for a Vanguard fund, that concerns me some, and especially a Vanguard fund that's been around for quite some time. Let's look at VDIGX, for instance, and that's 41 billion. All right, so that's less than a. Whoa, buddy, just sneezed on me. Thanks, appreciate that. All right, so just under 2 billion that's concerning to me, and I'll share with you why. Inception, May of 2008. Look, I like Morningstar ratings and all that, but I don't pay a whole lot of mind to it. Look, it's better to get a 5-star rating, sure. At the end of the day, if you don't get a 5-star rating, it doesn't bother me all that much. The yield, I already said the yield, 6.44%. So that looks good, doesn't it? Yeah, that looks great. 6.44%, and the expense ratio is a paltry 32 basis points. So just for the FYI, a basis point, if you have 1%. So you're up 1%, that's called 100 basis points, all right? So 1 basis point is 1/100th of a percent. So if you have 50 basis points, it's 1/2 of 1%. Just keep that in mind. I was talking to a couple yesterday or the other day, and I kept saying the basis points, and finally she said, "Can you just explain?" Almost sheepishly, I guess. Can you explain what basis points was? I said, "Man, I should know better. I shouldn't be talking in my vernacular." That actually annoyed me on my end, that I forgot that a lot of people don't follow this like I do. But anyway, all right, so let's dive into this. All right, so now I want to show you something here, and we're going to go to the returns, the performance. What's up, growls? And we're going to just go year over year over year. And we'll see in 2019 it was up 15.64, so about half the S&P 500. 2018 was down 5.67, more than the S&P 500. And we'll compare these side to side. 2008 it was down, even though it doesn't show here because it's only partial year. 2009 was up 23 points. So you can see it. So we got 10 years, or I guess 11 years, of which 2 were down and the rest are up. All right. One was only down 72 basis points, so not very much. So that looks pretty good, I suppose. Let's look over here. It seeks to make monthly cash distributions while seeking to have those distributions invested capital keep pace with inflation over time. Hold on a second, let me get him out of here. The investment seeks to make monthly cash distributions while seeking to have these distributions in capital keep pace with inflation over time. It invests in Vanguard funds and other investments according to an asset allocation strategy designed to provide shareholders with a regular cash flow from the investments in the fund. It may allocate its assets across a broadly diversified. So whatever. So let's see what the holdings are here. All right, and then we're going to go into the performance because it's a little bit concerning me. So 88% in stocks. Eesh. 6% in bonds and 3.5% in cash. That's concerning. And then look, here's the fund. So while it's 32 basis points on this, you have to average probably another 5 to 10 on all these things. But Vanguard Total International Stock Index, that's one of the reasons. We'll just go into this, but you can see all the other funds it has. So it's almost like a fund of funds. Never been a big fan of fund of funds. Generally speaking, I do like the Vanguard Life Strategy Growth Fund, but generally speaking, I'm not a huge fan of fund of funds. But in this case, it's fine. It depends. All right. So we see it's pretty heavy into equities, which was, look at this. PE ratio is 12.66, which is pretty low. Price to book is 2, which is pretty low. The reason for that is because it gets such an exposure internationally. Vanguard is really keen on international. But, all right, so let's go into this. We'll see if I can't make this bigger. All right, so what I've done here is I took in the, before we go, let's go over here first. All right, so what I've done here is I've taken the if I've taken the dividends that paid out on a monthly basis and I annualize them each and every year. All right. So what happens here? So we start in April 2008, and then we go to at the end of 2008 to pay 66 cents a share dividend. So as $20, it was the opening price on basically in April 2008, $20. I guess you could say May 1st, the same thing. It closed the year at 13, and it paid 66 cents of a dividend. All right, so 66 divided by, we'll even say both of these purchases divided by 13.68. That's a 4.8% dividend distribution on this end of year account, which is significantly down from what it was at the beginning of the inception. It's 0.66 divided by 20. So you're talking between 3 and 5%. Nothing to write home about. All right, now I want to show you something. Look at this. It went down to 11.85, man. I mean, it went down from 20 to 11.85, a 40% decline at the end of February 2019. I don't even know what it was. I tell you what, let's take a gander at what it was on March 9th of 2019. Let's go to historical data. We'll go to March 9th of 2019. I'm just curious because that is the doomsday. Doomsday. Put historical prices. Yeah, right there. Well, we get the date here. Start day. 2009. We'll go to end day. 03. Let's go 0310. 2000 and 200. 2009. Okay, let's see what we got. Boink. Get my mug out of the way. Hit apply. And so what happens, this guy fell all the way to, 1126. Wow. So 20, so we got 1120 minus 1126 divided by 20. That's 44%. So this sucker fell 44% during that time. Oosh, that's painful. And you can see, so 66 cents was the dividend you received in 2008. 84 cents was the dividend you received in 2009. 57 cents was the dividend you received in 2010. 78 cents. So if you look at 78 cents divided by 15.75, that's again 4.9% distribution yield. All right. 79 cents in 2012. $1.83 in 2013. They had a special dividend of 99 cents. I don't know what to attribute that to, but still $1.83 divided by, we'll just use this 1877. That's a 9.75% distribution rate. That's kind of weird, huh? So $1.83 divided by 18.77. Yeah, that's unusual. So that's a special dividend for sure. Why? I don't know. 2014 had a 71-cent dividend distribution. Then we have another special dividend distribution. I don't know what to make of that. I don't know. Is it capital gains? I have no idea. $1.07 in 2006. 16, excuse me, 71 cents again in 2007. So you can see there's some inconsistencies in the dividend payout. 2018 is $2.38. What's that about? And then finally, 2019 is $1.09. So we have $1.09 divided by 17.01. That's a 6.4% yield, which is what we're showing on Yahoo. If you go to summary, the 6.4% yield is what this will show us. 6.4%. All right, is that what you're going to get? No, because yield is the backward looking. What did it pay relative to its current price? And in fact, if we look at the yield relative as what do we say, $1.09, $1.09, yeah, 109. 109 divided by the price right now is 16.91 divided by 16.91. That's yeah, there you go, 6.4% dividend yield. All right, let's look at this in terms of. Let me make this smaller again. I want to show you this graph I created. So here you can see the dividends, 75 cents, 95 cents, 57 cents, 80 cents, 80 cents, around $2, around 75 cents, about $1.50. It's just all over the place, but certainly not growing. I mean, it's growing a little bit, but if you were to look at it like the trajectory, it'd just be kind of like this. I'm sure I could do this here, but I don't feel like it. That's not a significant growth of dividends. And the price was 20 when you bought it, and now it's, watch this. It's 16.77. So if you took the dividends out to live on, all right, which is what you would probably do because you're buying this for the managed payout, you're sitting on you're sitting on $20 minus 16.77 divided by 20. you're sitting on 16% less capital. You have 16% less capital over the course of 11 years, which is a 1.45% depreciation. It has lost 1.45% a year. Doesn't it have something to tell you about the actual dividends it pays, that some of the dividends are coming from principal? Absolutely it does. Now, if you took the dividends, you would have received 64% dividends on your initial investment. You received $12.89 on initial investment of $20. So if you did not reinvest, you would say, okay, for every $20 share, I had $12.89 of dividends plus $16.77 is my net value, which means $20 invested, paid $12.89 of total dividends, and is also worth $16.77 today. So I would have had, so $20 invested would have paid me $16.77 plus $12.89. I would have basically 50% increase in my total return over the course of that time, over 11 years, which is essentially a 4.5% rate of return. I would have received 4.5% on my money over the course of the last 11 years. That's not good. That's not good. That's essentially a bond, and yet is a whole lot more volatile than a bond. If I reinvested the dividends, I would have. I mean, I'll show you here in just a second. But again, I paid $20 for a share. For each share, I got $12.89 of dividends, and I have $16.77 left to show for it. So my $20 per share is the sum of these two numbers right here, which is roughly $30. Does that make sense? So I've made $10 on my $20 investment. Over the course of 11 years, that's about 4.5% interest. That doesn't get the job done. When you see, look at that decline. Look at that decline. I mean, it fell to, like I said, 11.25 or something like that. It's climbed back up, but it's still sitting right here. I mean, it still has never broken even again. Will it ever break even? No, it won't. And I'll tell you why. Because it cannot continue to pay out that dividend. That dividend has to come from someplace, and it's coming from principal. So principal is going to keep driving the share price down. They're going to pay principal and pay principal. Essentially, this is one of the drawbacks of income annuities is you're getting portion of your money is getting from the insurance company, and a portion of your money is coming from your principal. That's how it works. Your dividend, your distribution yield is not interest rate. It's literally what are you getting back on a monthly basis, real time, what you put in. Same thing is here. The exact same thing scenarios here. Now, they're not going to call this an income annuity, but it works the same concept. They are paying you a portion of their principal. And as you can see, unlike an income annuity, that right there is a stock. And that right there is a stock. It's not a bond. It's not an annuity. It is stocks, which means it got hammered in 2008 and then again in 2018 as well. All right, so what's happening here is for them to maintain this kind of dividend, there is no way they're going to be able to maintain that unless there's coming more and more from the principal. And this is my thing. I had a guy just rip me apart on Ginnie Mae. The problem with some of these contracts, some of these positions, that people think it's a dividend yield of 6.44%, i.e. that's what they're getting on their capital, as if they're not touching their principal. And that's not true. That's not true. You are not getting 6.44% as total interest. You're getting a portion of that is your return of principal, or they're not going to. That's what an annuity would say. They're not going to say that though. They're not going to say that because I don't know why. But that's what you got to understand. Now let's look at this chart. All right. So here's your adjusted close. This would show if you reinvested your dividends as opposed to taking it off as an income stream. Now, I don't know why you'd invest this and reinvest your dividends. That doesn't make sense to me. But if you reinvested your dividends, you would have had a 9.4%, 9.46 would be your starting value, and you have 16.77 is your future value, and you have 11 years, and you'd have no payment. That would give you a 5.34% rate of return. So if you would have reinvested your dividends, it would have given you 5.34. Nothing to write home about. Now this chart right here will show you. Let me just make this smaller. This chart right here will show you the difference. So the blue is taking your dividends, and you can see it just getting hammered, and then not reinvesting. And the red is reinvesting your dividends, essentially saying, what would you have started off if you just reinvested your dividends? What would your total return have been? And you can see if we go to 2009, March, 622. If you would have invested in March of 2009, 6.22, 6.22. You would have had a 9.43% rate of return because you were literally down. You just got hammered, man. You were down $11. But you didn't do that. You invested in April of 2009, as opposed to March of 2009, which meant you only made 5.5% since inception. It's just, there's nothing. Here's nothing good at all about this. Let's see if I got anything. Yeah, right there. 4.88% with adjusted close. Again, adjusted means you're reinvesting your dividends. 1.45% non-adjusted, and non-adjusted is not reinvesting your dividends, just taking out the dividends from a price per share. Adjusted close is reinvesting. Over the last 11 years, that is just bad. That is not. There's nothing good about that at all. Now let's compare it to the S&P 500. All right. So the S&P 500, what happens is, this is the end of month price and adjusted price. So the end of month price, that's if you take your dividends as cash. Your adjusted price if you just let it go. And what you can see here, we're starting with 100. All right, that's adjusted 101.05. Taking the dividends and not reinvesting is 127. And you can see what's going on here. We are literally almost tripling of our rate of return on investing it and reinvesting dividends or not taking the dividends. Either way, we basically have tripled our returns on this. Whereas if we look at this guy, I want to look at this guy instead. We're not anywhere near, we're not even breaking even here. Look at that. We are underwater relative to price per share. If we taken our dividends, and if we haven't taken our dividends, reinvest, we're only making about 5% a year. The S&P 500, look at that though. All right, so let's keep going down. All right, so here. With the S&P 500, you would have received a 7.3% annualized rate of return if you took your dividends as cash. 7.3%, which means you would have more than doubled your money, frankly, because we had 11 and a half years in which to let the markets roll for us. So we would have more than doubled our money. For simplicity, we'll just say double our money. If you would have reinvested it, you would have had a 9.43% rate of return over the course of those 11 years, essentially almost tripling your money. All right, now in the S&P 500, if you would have taken your dividends, one share was paid $127 at that time, you would have received $38 in total dividends. All right, $38 in total dividends. Or you would have received 30% of if you bought one stock, one share price, you would have received 30% in total dividends of that share price. So basically, you take $38 of total dividends, what you received, divide it into your share that you initially bought. You would have received 30% of your initial premium, your initial investment, back as dividends. If you would have done the same on the managed payout fund, you would have received, I think it was 64% of your initial investment. Again, showing you how much they're tapping into principal. All right, now watch this. 127 invested, paid $38, basically $39 of dividends. Is worth $298 today. So if you took your $38 in dividends and your $298 and what the price of VFINX is today, you add those two together, 127 would have been your initial investment, and it's worth $336 today in terms of total dividends. And if you would have not reinvested, just took the dividends in cash, and in terms of price per share. Does that make sense? So now we take 127 as our starting point. We say 11 years, 11N. We don't have any more payments. We have 298 as our future value. That is an 8.06% rate of return if you factor in your dividends that you receive plus the share price that is appreciating. It just is nuts. All right. Now I want to show you something else. Watch this. All right. So here is the S&P 500. So let's go back to VPG, the managed payout fund. I want to show you. They paid $1.09 in 2019 for dividends. All right. When we started, they paid 66 cents a share in dividends. Now they're paying $1.09. All right. So let's go to the S&P 500, shall we? The S&P 500 for one share. Now there's some. I'll share with you here in just a second. They paid. I don't even know what that is. 40. What is that? 57, 65. I can't even calculate that. That's quarterly. So there we go. And we'll go 2009. They paid 90 cents. Yeah, basically $2. They paid $2 a share in 2009 in dividends. $2 a share in 2009. $2 a share divided by a closing price of $98, that's about 2% dividend yield. Whereas VPGDX didn't have a 2% dividend yield back then. It paid 66 cents on 13.68, so it had a 4.8% dividend yield. So they had basically more than 2 times the dividend yield of the S&P 500. But watch this, the S&P 500, if we scroll down, has dividend yields now, a dividend payout of $1.39, $1.30, $1.22, $1.36. So we take 1.35 plus 1.22 plus 1.3 plus 1.39. That's $5.26 per share. So the S&P 500 is paying us $5.26 per share, where one share of this fund is VPGDX is only paying what do you say, $1.09. Now what you could do, you could say, okay, Josh, that's true, but it cost 6 shares for every 1 share of the S&P 500. So it cost, you had to have 6 shares of VPGDX for 1 share of the S&P 500. In terms of, if I had 1 share to buy, it would have cost me $127 for S&P 500 or $20 of this fund. And that's true. I mean, absolutely. In terms of capital that you would have to invest, you would have to invest 6 times as much in this fund to equate your freaking amount that you put into the S&P 500. Even then, you can say, okay, so we're going to get $6 of dividends here, whereas before we were getting, which relative to the S&P 500, we're still getting $5 of dividends in the S&P 500. So before, when we're at the S&P 500, we only got $2 of dividends, whereas before with a VPGDX, we had, if we take that 66 cents, 0.66 cents times 6, we got $3.69. So what's happening is each and every year, the dividend payout is growing larger and larger and larger on the S&P 500, and the value of the stock has been growing. Sometimes the value get hammered, I get it. But what's happening is you have progressively more and more and more and more dividends because it's making money. Your accounts are growing. You're reinvesting your dividends, getting more shares. However you're doing it, you're taking the dividends out. But the earnings growth on the S&P 500 are growing, in which you are being rewarded with more dividends, unlike the VPGDX, which are tapped into more and more principal. I know some of that's probably confusing, but I'm just telling you. I mean, you made significantly more income and money in the S&P 500 than you did in VPGDX, even though VPGDX is heavy into stocks anyway. I mean, if you're going to have a heavy stock and you're paying 6.44%, inherently a bulk of that has got to come from principal. There is no other way around that. So how many people are buying this thinking Vanguard is going to protect their downside like an annuity or some 4% rule, and they're going to wake up and have cash left over? You cannot pay 6.44% yield on a stock fund today. You just can't. Not if you're paying it out on a regular basis and they're doing it every month. It's impossible unless you're tapping into principal. And if you're tapping into principal, as we all know, and the principal starts declining, what happened in 2008? Look out below. You can't make money there. You're basically living off on borrowed time. You're living off your principal, and that principal will be exhausted at some point. Whereas the S&P 500 is just growing and growing and growing to the state that you're now getting for 1 share. You had $2 of dividends when you had 1 share of the S&P 500 2008. You had 66 cents of dividends when you had 1 share of VPGDX in 2008. Now you have over $5 of dividends. That has grown by 2.5%, where the VPGDX has only grown by, it's just doubled essentially, and that's doubling is your capital. Because don't forget, just real quick, this right here on the S&P 500, your price per share is at $298, where it started at $127. The price per share on VPGDX started at 20 is at $16.77. So you've doubled your dividends essentially, but you've lost 15% on capital. On the S&P 500, you've 2.5 times your dividends, and you've grown your capital by 2.5 times. That's, in my opinion, it's nothing. There's no reason to mess with the VPGDX. I'm just telling you right now. Hope this helps. Go to the barbell. You have stocks and you have cash. Stocks and Ginnie Mae. Do not mess with the managed payout funds. All right, if you have questions, put them in the notes. We'll see you below. And we'll see you next time.